A quiet day on Wall Street, but not a quiet week at all. Stock market volatility is back, and it may not go anywhere anytime soon. This week's ups and downs were caused by all of the global uncertainties we've been telling you about, including Great Britain's vote next week on whether to leave the European Union and the Federal Reserve's forecast of slow economic growth. The Dow Jones Industrial Average capped this rocky week with a decline of 57 points, finishing at 17,675. NASDAQ dropped 44, and the S&P 500 fell 6. For the week, all of the major indexes lost more than 1%. And concerns over slow growth may not bode well for one of the most critical forces in investing, corporate profits.
Forget the Fed. Set aside the vote on Britain leaving the European Union. In the long run, and probably the short run too, what matters most to stock prices is, yes, corporate profits, the mother's milk of money making. And the profit outlook, weak all year long, is getting worse. FactSet says U.S. corporate profits will likely fall more than 5% this quarter. S&P Global Market Intelligence thinks they'll slide 4.7%. If profits do decline this quarter, and there's only 2 weeks left to go, it'll make for the 5th such quarterly decline in a row. That will be the worst such skid since 2009 in the midst of the Great Recession. Make no mistake, lots of companies are earning plenty, just not as much as a year ago. Banks are one example. For them, profits are simply harder to come by in today's highly regulated, low-interest rate world. Ditto energy companies, likely to show the biggest earnings declines from last year. There's not much glitter in materials and mining either, or, for that matter, in technology. Once the driver of corporate profit growth, tech companies overall may make less this quarter than they did last year. One contributor to the slide, amazingly, is Apple. Sure, it's making tons of money, just not like it used to. So get ready, folks, for a lumpy, bumpy run of corporate profit reports as summer heats up.